All right, let's get into it. Today, we're going to demystify one of the most debated and honestly, one of the most misunderstood tools in the world of personal finance, cash value life insurance. You see, it's a lot more than just a life insurance policy. It's a financial vehicle with some really unique features that we're going to break down piece by piece.
You've heard this a million times, right? Buy term and invest the difference. It's the go-to advice, the classic mantra. But like any simple rule, you've got to ask, is that really the whole story? So let's pull back the curtain on that piece of advice and really explore what that difference could actually mean for your financial future.
Okay, so to really get cash value, we first have to understand the big debate at the heart of life insurance. It really all just boils down to one fundamental choice. Are you looking for temporary insurance, or are you looking for permanent protection?
So what's the actual difference here? Well, you've got term life. Think of it like renting. It's pure, simple protection that covers you for a specific period of time. A term, say 20 or 30 years. It's affordable, it's straightforward. Then you have whole life. This is more like owning. It's permanent, designed to last your entire life. And here's the game changer. It has a built-in savings component called cash value. Now, this does make it more expensive up front, but as we're about to see, it also makes it a way more powerful financial tool.
So let's zero in on that cash value. This is really the engine of the whole policy. It's what transforms it from just being a safety net for your family into a financial asset you can actually use while you're alive. But how does it work? How does this money actually build up?
Let's get a clear definition. What is cash value? Put simply, when you pay your premium, a portion of that money, instead of just covering the insurance, goes into a special account inside your policy, and that account grows over time. The best way to think about it is like building equity in a house, but you're doing it inside an insurance policy.
And the way it works is actually pretty simple. First, you pay your premium. A piece of that money covers the pure cost of the death benefit, the insurance part. But the rest of it, that gets deposited right into your cash value account. And then that money starts to grow, tax-deferred, compounding year after year.
And this right here, this brings us to the real superpower of cash value life insurance. The reason this thing is considered such a powerful planning tool isn't just because of the growth. It's how that growth and the benefits are treated by the tax man.
First things first, the main reason for life insurance, the death benefit. When your loved ones, your beneficiaries, receive this money, it is completely 100% free from income tax. It doesn't matter if it's $50,000 or $5 million, they don't owe a single cent of income tax on it. That's huge. Now this is where it gets incredibly powerful for you. While you're still around, you can actually get your hands on the money in your cash value account by taking a loan against it. And the money you get from that loan, it's not considered taxable income, zero tax. Now why is that? Well, it's simple. You're not technically withdrawing your money. You're borrowing against it from the insurance company, and your cash value just acts as the collateral. It's a totally unique way to get cash without triggering a tax bill.
And the engine that makes all this possible is tax-deferred growth. Just like with other retirement accounts, your money gets to grow without getting hit with taxes every single year. This lets your cash value compound way more efficiently over the long run, building a much bigger asset base inside that policy.
Okay, so we know it grows, and it grows with some amazing tax advantages. But what can you actually do with it? I mean, this isn't just some number on a statement. It's a flexible asset that has a ton of strategic uses.
And this is where it all comes together. You can literally create your own tax-free income stream in retirement by taking those policy loans we talked about. You can tap into it for an emergency or for a business opportunity. Down the road, the policy can even start paying for itself using its own cash value. And all the while, you've got this incredibly powerful tool for passing on generational wealth.
Now, of course, with a tool this powerful and kind of complex, there are bound to be some myths and misconceptions floating around. So let's just tackle the two biggest arguments you'll hear against cash value life insurance head on.
This is the big one, right? The one you hear all the time. And you know what? On the surface, it's true. The premiums you pay at the beginning are a lot higher than they would be for a term policy with the same death benefit. But that's not the full story.
Here's the crucial mindset shift. You have to reframe what that cost is. A big piece of that higher premium isn't an expense that just disappears into thin air. No, it's a contribution to an asset that you own, your cash value. The real net cost of the insurance is what you've paid in premiums, minus the accessible cash value you've built up.
Okay, the second big criticism is all about performance. People will say the growth rate inside one of these policies just can't keep up with the stock market. And again, they're not wrong, but they are absolutely comparing apples to oranges.
Look, this type of policy isn't designed to replace your stock market investments. It's meant to be the safe, stable, predictable part of your portfolio, kind of like your bond allocation. It provides conservative growth, but it does so with those tax advantages that most other safe investments just don't have. It's all about stability and tax efficiency, not about trying to hit home runs.
And building on that point, it's super important to know that cash value isn't just one single product. There are actually different types. We've mostly been talking about whole life, that's the first column, which has fixed premiums and really predictable growth. But you've also got universal life, which gives you a ton of flexibility in how much you pay and when. And then there's indexed universal life, or IUL, which links your growth to a stock market index, giving you more upside potential, but with built-in protection so you don't lose money in a down market. The key here is you can choose the type that actually fits your goals and your comfort level with risk.
So, after all of this, we finally land on the most important question of all. This isn't about whether these policies are good or bad. It's about figuring out if it's the right tool for your specific situation.
And really, the answer comes down to this. What are you trying to accomplish with your money long term? Are you looking for lifelong protection for your family? Are you looking for another place to grow your money in a tax-efficient way? Is passing on an inheritance or planning your estate a top priority? When those are your goals, that's when a tool like this really starts to make a lot of sense.
And in the end, that's the real takeaway. Cash value life insurance isn't some simple product you just buy off the shelf. It's a complex, powerful financial tool. And no, it's not for everybody. But for the people who can make that long-term commitment, it can be a gateway to a more tax-efficient, more stable financial future, all while providing that peace of mind for life. Thanks for tuning in.